So the consensus, and this is interesting to me. So 2013, we started the market, we were maybe a little bit undervalued. 2013 happened, at the end of 2013, we were overvalued in the S&P 500. And we have been overvalued ever since. 2014, we got a little bit more overvalued, and we'll look at this in a second. And in 2015, they're saying, we're going to get a 10%, this is the Wall Street strategist, we expect a 10% return on the S&P 500. But we actually expect a 7.5% increase in earnings. So what they're saying is, by the end of this year, we'll even be more overvalued than we are now. We're expecting the market to keep going up faster than earnings going up. When we started on the second law, what was the second law of investing? What do stock prices follow eventually? Earnings. So if stock prices keep going up more than earnings, and keep going up more than earnings, and keep going up more than earnings, what happens? Correction. We correct back down to where earnings are, but is the stock market calibrated to stop where earnings are? No. It never goes, oh, here's earnings. It doesn't do that. It goes down to here. Oh, wait a minute, we missed earnings, and it comes back, right? Because once it's here, it's like worried, what if earnings aren't real? Oh, we're going to go down here until we know that earnings are real. So in the last 200 years, there's I don't know who is it Schiller? Someone has a line. It's a 6.5%, 7% earnings increase line. And the line it's almost perfect from beginning to end. It's about a 6.5%, earnings go up at about 6, 7%. There's a little bit of financial leverage that a company can employ to make it 10%. So we can actually get higher earnings than that. But to have stock prices go more than 10, just once you see that many years in a row, you know there's going to be some kind of correction. At the same time, oh, here we go. Is it the next one? No. So here, this is the 5-year average, the lower line, and then the dotted line's 5-year. This is the 10-year average. We're here. This is 2006. Is that right? Yeah, 2006. This is the bottom in 2008 and 9 of PE ratio. So we're here. We were up in 1999, 2000. We were up in this range. We were up here, 22, 23. So there's times in the past when it's been much higher than this. However, there are lots of metrics of valuation. Warren Buffett's favorite metric of valuation is the stock market valuation, which he uses as Wilshire 5000. So he looks at the big market, everything, divided by GDP. And the big market divided by GDP is higher than it's ever been. So Warren Buffett's valuation metric, highest valuation we've ever seen. PE ratios off the chart, higher than 2000, which is an interesting thing to tell us. So I remember when I was doing these conversations in 2008, and it was very dour. I'm starting to get that feeling again. It's really negative. It is what it is.